It is the most exclusive club on Earth. Every year on December 10th, the anniversary of Alfred Nobel's death, the world's intellectual royalty gathers in Stockholm. The dress code is white tie and tails. The guests are monarchs and laureates. The atmosphere is thick with the scent of history and absolute achievement. Physics, chemistry, medicine, literature, peace. These were the pillars of human progress established in 1895 by the dynamite tycoon himself. But if you look closely at the roster, there is an imposter among them. Alfred Nobel never cared for economics. In his original will, there was no mention of a prize for the dismal science. He was a man of practical invention, explosives, ballistics, literature that uplifted the human spirit. To him, economics was perhaps too theoretical, too messy, or simply too boring to warrant a share of his fortune. So how did we get here? The year was 1968. The Sveriges Riksbank, Sweden's central bank and the oldest central bank in the world, was celebrating its 300th anniversary. They didn't want a party, they wanted legitimacy. They wanted to elevate economics from a soft social study to a hard science, sitting right next to physics on the pantheon of truth. So they made a donation, a massive one. They established the Sveriges Riksbank Prize in Economic Sciences in memory of Alfred Nobel. Notice the wording, it is not a Nobel Prize, it is a prize in memory of Nobel, paid for by a bank. It is quite literally a relentless marketing campaign that succeeded. By sharing the stage, the lighting, and the king's handshake, economists convinced the world that their field wasn't just about opinions, it was about laws, natural laws. And for decades, the committee rewarded theories that reinforced this idea, that markets were efficient, rational, and predictable. They handed medals to men who claimed the economy was a perfect machine. But in 2003, the committee did something different. They didn't give the prize to men who said the market was perfect. They gave it to two men who admitted that the market is a terrifying, volatile beast that we can barely comprehend, let alone control. This is the story of how the Banks Prize finally recognized the case of the real world. Meet the winners of 2003. On one side, we have Robert F. Engel. He didn't look at the stock market and see a line going up or down. He saw a heartbeat, sometimes steady, sometimes racing in absolute panic. He realized that the risk of the market wasn't constant. It came in clusters, like earthquakes, quiet for years and then absolute destruction in a matter of days. On the other side, Clive Granger, a man who looked at two lines moving together on a chart and asked the most dangerous question in statistics. Are they actually dancing together? Or are they just both drunk? Together, they destroyed the illusion of simplicity. Before them, economists treated volatility, the wild swings of price, as just noise, a nuisance to be ignored. But Engel and Granger said, no, the noise is the story. They gave us the mathematical tools to measure fear itself, the ARCH model and cointegration. But here's the paradox. These tools were meant to make the financial world safer, to help banks build better shields against the crash. Yet, just 5 years after they won the Nobel Prize, the global financial system collapsed in 2008. The shields failed. So did their math fail, or did we misuse the weapon they gave us? To answer this, we have to go deep into the mechanics of financial disaster. In the next 15 minutes, we are going to answer 3 massive questions. Question 1. Why did the smartest people in the room believe for decades that the market was safe and rational? Question 2. How did Engel and Granger prove that chaos actually follows a pattern? This is where we decode the famous ARCH equation. Question 3. Are these Nobel-winning formulas actually protecting our money today? Or are they just giving us a false sense of security before the next big crash? Buckle up. We are about to measure the unmeasurable. To understand why the 2003 prize changed everything, we have to go back to the Old Testament of economics. For most of the 20th century, economists were obsessed with a beautiful symmetrical lie. It was a concept called homoscedasticity. Now, don't click away. It sounds like a tropical disease, but it simply means the scatter is the same. Imagine you are shooting arrows at a target. Sometimes you hit the bullseye, sometimes you miss. Homoscedasticity assumes that your skill level never changes. The spread of your arrows today will be exactly the same as the spread of your arrows tomorrow, next week, and next year. The error margin is constant. Applied to the stock market, this meant that risk was a flat line. Sure, prices go up and down, but the probability of a crash was supposed to be stable. Like a coin flip, the odds of heads are always 50-50, Whether you flip it on a calm Tuesday or in the middle of a hurricane. Why did smart people believe this? Because they needed to. If you assume risk is constant, the math becomes incredibly elegant. You can use the famous bell curve, normal distribution, to predict the future. You can build powerful tools like the Black-Scholes equation to price options. You can look a client in the eye and say, based on the last 50 years of data, the chance of you losing 10% in a single day is 1 in a billion. It made the chaotic world of money feel like a physics laboratory. Predictable, safe, solvable. Banks loved this. It allowed them to package risk into neat little boxes and sell it. They treated the economy like a machine that might vibrate a little, but would never explode. But there was just one problem with this perfect model. The problem with the perfect model was simple. The real world refused to behave. In the 1970s and 80s, the economy started doing things that shouldn't be mathematically possible. Inflation skyrocketed, oil prices quadrupled, and stock markets didn't just fluctuate, they had seizures. According to the standard constant risk models, the bell curve, a crash like Black Monday in 1987 was a statistical impossibility. It was an event that should happen once every billion years, yet there it was, wiping out 22% of the market in a single afternoon. The economists checked their equations. The equations said, this is safe. The traders looked at their screens. The screen said, you are bankrupt. Two specific anomalies emerged that broke the old faith. First, volatility clusters. Traders noticed that panic was contagious. If the market was wild today, it didn't reset to calm tomorrow, as the coin flip theory suggested. It stayed wild. Risk wasn't random, it was sticky. When it rained, it poured. The old models were like a weatherman predicting a light drizzle in the middle of a typhoon. Second, spurious correlations. This was the trap Clive Granger saw. With the rise of computers, economists started running regressions on everything. They found patterns everywhere. Here's a famous example. If you plot cumulative rainfall in Scotland against inflation in the UK, the lines might look almost identical. A standard economic model would say, aha, rain causes inflation. It was nonsense. It was a statistical mirage. But governments were making trillion-dollar decisions based on these mirages. We were building skyscrapers on quicksand, using rulers that were bending every time we tried to measure something. The field of economics faced a crisis of credibility. They needed a new way to separate the signal from the noise. They needed someone to rewrite the laws of time. Robert Engel was in London looking at inflation data. He was frustrated. The standard models kept failing because the errors in his predictions were clustering together. Big errors followed big errors. Small errors followed small errors. Most economists would have added a dummy variable to smooth it out, basically cheating the math to make it look pretty. But Engel did the opposite. He stopped asking, what is the price tomorrow? And started asking, what is the volatility tomorrow? He realized that while you cannot predict whether the market will go up or down, that is still random, you can predict how violent the move will be. He published a paper with a terrifying title, Autoregressive Conditional Heteroskedasticity, ARCH. Let's decode this beast. It sounds like gibberish, but it is actually a sentence. A heteroskedasticity, meaning different scatter. The opposite of the lie we talked about. Risk changes. Conditional, meaning it depends on the current situation. Risk is not fixed. It reacts to news. Autoregressive, meaning it remembers the past. Yesterday's panic feeds today's panic. Put it together, and Engel was saying, the risk of tomorrow depends heavily on the shock of today. This was revolutionary. Before Engel, risk was treated like background static, constant and boring. After Engel, risk became a living, breathing creature. It had a pulse. It had memory. He wrote an equation that allowed banks to input today's market swings and output a specific number for tomorrow's danger level. He didn't just describe the storm. He built a barometer that could tell you when the pressure was dropping before the hurricane hit. Simultaneously, Clive Granger was solving the drunken dog problem, cointegration. He proved that two wild variables could look random individually, but be tied together by an invisible rope in the long run. He gave us the math to distinguish between a fake correlation and a real economic bond. But how do we explain this invisible rope and living risk to someone who hates math? We need a casino. Imagine the global economy is not a machine, but a giant, smoky casino. First, let's look at Robert Engel's insight, ARCH. Stand in the middle of the roulette floor. Close your eyes. Don't listen to who is winning or losing. Listen to the noise volume. For an hour, it might be quiet, just the gentle click-clack of chips. Low risk, low volatility. Then suddenly a high roller walks in. He bets $1 million. The crowd gasps, the noise spikes. People start shouting. The old economic models assumed this noise would instantly disappear and go back to silence. But Engels said, no, if the crowd is screaming now, they will probably still be screaming in 10 minutes. Panic echoes. Fear has momentum. By measuring the decibels of the casino right now, ARCH allows us to predict how dangerous the room will be tomorrow. It doesn't tell you what number the ball will land on, but it tells you how much your hands will be shaking when you place the bet. Now step outside the casino. Meet Clive Granger's contribution. Cointegration. You see a drunk man stumbling out of a bar. He is staggering left, right, forward, backward. His path is completely random, unpredictable. Now look at his dog. The dog is also wandering, sniffing a lamppost, chasing a leaf. Its path is also random. If you analyze them separately using old math, they look like two chaotic, unrelated variables. But look closer. There is a leash. The drunk man is the stock market. The dog is the real economy or dividends. In the short term, they can be far apart. The man might stumble into the gutter while the dog is on the sidewalk. But because of that leash, the cointegration, they cannot drift apart forever. Eventually, the dog must follow the man, or the man must get pulled back by the dog. Granger gave us the math to see the leash. He taught us that even if two lines on a chart look like jagged, drunken messes, if they are cointegrated, you can bet your life savings that they will meet again. These two metaphors, the echo of fear, ARCH, and the invisible leash, cointegration, were the keys to the kingdom. They allowed Wall Street to quantify chaos. And armed with these new weapons, the banks felt invincible. They built massive risk management systems. They thought they had tamed the beast. But there is a tragedy in every Greek myth. When you think you have conquered nature, nature is usually preparing to strike back. Fast forward to the mid-2000s. The Nobel Prize has been awarded. Engel and Granger are legends. Their equations are no longer just on chalkboards. They are hard-coded into the mainframe computers of every major investment bank from New York to Tokyo. The financial world had entered a period called the Great Moderation. Inflation was low, growth was steady, the sea was calm. Inside the banks, risk managers were looking at a dashboard called VMAER, value at risk. This was their ultimate shield. It used Engels' volatility models to answer one question every morning. How much money could we lose on a really, really bad day? Because the market had been so quiet for years, Engels' equation, which relies on past memory, fed this calmness into the future predictions. The equation looked at the recent past and whispered, all is well, the risk is minimal. Traders took this green light and hit the gate. Since the measured volatility was at historic lows, they felt safe to take on massive amounts of debt, leverage. They bought subprime mortgage bonds. They built complex derivatives. Why? Because the math said it was safe. The VIX index, often called the fear gauge, a direct descendant of Engels' work, was sleeping at the bottom of the chart. It was a feedback loop of complacency. The lower the calculated risk, the more risk they took. They were driving a Ferrari at 200 miles per hour because the speedometer said 20 miles per hour. But they forgot the one rule Engel tried to teach them. Volatility clusters. It doesn't arrive politely. It explodes. Then the first tremors started. A few hedge funds began to crack. The subprime bonds started to smell bad. Suddenly, the inputs in the ARCH equation changed. The daily variance wasn't 0.5% anymore. It was 2%, then 4%. The model woke up. And when it woke up, it didn't just ring a bell, it screamed. The banks looked at their risk models and realized with horror, the shield isn't working. It's actually amplifying the damage. Monday morning, Lehman Brothers files for bankruptcy. The invisible dam breaks. Now watch what happens inside the computers. Robert Engels' ARCH model, running deep inside the risk servers of Morgan Stanley, Goldman Sachs, and hedge funds, suddenly received a new input: infinite volatility. The echo of fear became a deafening siren. The value at risk, VAR, numbers skyrocketed. The algorithms looked at the new volatility and logically concluded, you are holding too much risk. You must sell now. And here is where Clive Granger's work comes in, twisted into a nightmare. Remember the drunk and the dog? In normal times, different assets, stocks, gold, real estate, move somewhat independently. They have their own paths. But in a panic, something terrifying happens. Correlations go to 1. The drunk and the dog don't just wander, they both jump off the cliff together. Suddenly, everything was falling. Real estate, down. Stocks, down. Corporate bonds, worthless. The diversification that banks thought would save them vanished instantly. There was nowhere to hide. This triggered a mechanical death spiral. 1. The arch models detected high volatility. 2. The risk managers forced traders to sell assets to raise cash, margin calls. 3. This massive selling caused prices to crash further. 4. The crash created more volatility. 5. The arch models screamed even louder. 6. Repeat. Step 1. It was a self-fulfilling prophecy. The very tools designed to measure safety became the engine of destruction. We didn't just have a market crash, we had a quant quake, a disaster amplified by the very mathematics meant to prevent it. Robert Engel and Clive Granger watched from the sidelines. Their equations were correct. The volatility was clustering, and the relationships were holding tight. But the speed of the collapse was faster than any human or machine could handle. The casino didn't just get loud, it caught fire. When the dust settled, $2 trillion had evaporated from the global economy. Giants like Lehman were gone. Merrill Lynch was sold for scraps. The Great Moderation was officially dead, but amidst the wreckage, a strange thing happened regarding our Nobel laureates. Usually when a theory fails to stop a crash, it is thrown into the trash can. But Robert Engel's arch models and Granger's cointegration didn't disappear. In fact, they became federal law. Why? Why it's fun? Because the post-mortem analysis revealed the truth. The math wasn't wrong. The math had actually predicted the turbulence perfectly. The problem was that the humans ignored the warnings until it was too late. For 2008, banks used these models to ask, how much can we profit while staying just inside the safety line? After 2008, regulators used these models to ask, if the world ends tomorrow, will you still be standing? This gave birth to stress testing, Dodd-Frank Act, Basel III. Today, every major bank in the world must run a simulation, a war game, using extreme versions of Engel's volatility clusters. They have to prove to the government that even if volatility spikes by 500%, a supercluster, they have enough cash to survive. The legacy of the 2003 prize shifted. It was no longer about predicting the future to make money. It was about measuring the darkness to prevent extinction. Engel and Granger taught us that we cannot stop the earthquake. The tectonic plates of finance will shift. The volatility will cluster. But thanks to them, we now build our houses with shock absorbers. We don't pretend the ground is solid anymore. We accept the shake. However, as we moved into the 2020s, a new danger emerged. A danger that even Robert Engel didn't foresee. What happens when the volatility comes from something that isn't financial at all? So are we safer today? The answer is complicated. While Engel and Granger gave us the flashlight to see in the dark, they also warned us about the battery. The fundamental flaw of the arch model, and indeed of all econometrics, is that it is backward-looking. It predicts the volatility of tomorrow based on the patterns of yesterday. It assumes that the rules of the game remain roughly the same. But what happens when the rules change overnight? Imagine driving a car down a highway. Your windshield is painted black. You can only drive by looking in your rearview mirror. As long as the road is straight or curves gently, you are fine. Engel's math is the perfect rearview mirror. It tells you exactly how curvy the road was 100 meters ago, so you can adjust your steering. But if there is a sudden cliff edge ahead that has never appeared on the map before, the rearview mirror is useless. You will drive off the cliff with perfect confidence. In economics, we call this a structural break. This is the danger we face right now. We are feeding these 2003 Nobel equations with data from a world that no longer exists. We are training them at 20th century cycles of oil and interest rates. But the volatility of the 2020s is different. It is not coming from market noise. It is coming from outside the system completely. Engel's model can predict how a stock reacts to an interest rate hike. But can it predict how a stock reacts to a global pandemic? Or an AI revolution that makes half the workforce obsolete? Or a sudden war in Europe? No. To the algorithm, these are alien invasions. They are not in the training set. And when you rely too heavily on a map that doesn't show the new territory, you get a false sense of security. You think you are managing risk, when in reality you are just managing history. If Robert Engel thought the stock market was volatile, Bitcoin is arch on steroids. In the crypto world, volatility clusters are not just waves, they are tsunamis. A tweet from a billionaire can trigger a variance spike that Engel's original model would consider statistically impossible. Yet millions of young people are pouring their life savings into this market, often without realizing that the risk management tools on their trading apps are still using the old math. They are bringing a knife to a nuclear gunfight. And it gets worse. Remember Granger's spurious correlation? The fake patterns? Today we have AI algorithms scanning the entire internet, looking for connections. These AIs are like super Grangers. They find correlations between everything. An AI might decide that Apple stock price is co-integrated with the temperature in Silicon Valley. Is it true? Probably not. It's likely just noise. But the AI trades on it anyway, moving billions of dollars in milliseconds. We are entering a world where machines might be trading based on hallucinations, creating artificial volatility that has nothing to do with the real economy. So what does this mean for you? You might think, I don't trade, I just have a savings account or a retirement fund. Here's the scary truth. Your pension fund, your insurance company, and your bank, they were all managed by these risk models. They are all using Engel's ARCH to decide how safe your money is. If the models work, you retire in peace. If the models fail, confused by a new war, a pandemic, or an AI flash crash, your safe assets can evaporate overnight, just like in 2008. You are a passenger in a car driven by a mathematical formula, and that formula is squinting into the rearview mirror, trying to guess what happens next. So the next time you hear a banker say, "Don't worry, our models show the risk is low," remember the drunk, remember the dying, and remember that sometimes the leash breaks. Back in Stockholm, the applause for Robert Engel and Clive Granger has long faded, but their lesson remains more urgent than ever. The 2003 Nobel Prize was a turning point. It was the moment economics finally admitted that it is not physics. Planets have fixed orbits. People do not. Atoms don't panic, markets do. Engel and Granger didn't give us a crystal ball to predict the next crash. They gave us something more honest, a weather forecast. They taught us that volatility is not an error in the system. It is the system. It breathes, it clusters, it sleeps, and it wakes up screaming. They taught us that co-integration binds the economy together, ensuring that reality always wins in the end, no matter how drunk the market gets. We live in a world that is desperate for certainty. We want our bankers to tell us it is safe. We want our politicians to say we have a plan. But if there is one thing to take away from the ARCH model, it is this: safe is a temporary state. Silence is just the prelude to the next noise. So don't trust the flat line, don't trust the calm water, and certainly don't trust anyone who says they have conquered risk. The only thing we can predict with 100% mathematical certainty is that we will be surprised.